time is yours.
Okay, so good morning, everyone, and thank you for joining the second session of the day. So you already have heard many, I would say, interesting ideas and big picture remarks. And this time, we're going to focus a bit more on the specifics, but at the same time, different views from central banks and international financial organizations. So without further ado, let me first ask each panelist to be on stage. So first panelist, Mr. Pierre-Olivier Gourinchas. Please. Okay, the second panelist, Mr. Piti Disyatat from Bank of Thailand. The third panelist, Mr. Firman Mochtar from Bank Indonesia. And finally, Mr. Claudio Borio from BIS is joining virtually from Basel. Yep. All right. So let me quickly introduce each panelist before we start the conversation. So first, Mr. Pierre-Olivier Gourinchas is Economic Counselor and Director of Research at the IMF. Before the current position, he was at the Department of Economics and the Hart School of Business at UC Berkeley. He was a Chief Editor-in-Chief of IMF Economic Review, Managing Editor of Journal of International Economics, and Co-Editor of American Economic Review. And he was also Director of International Finance, a macro program of MBR. And then let me introduce Claudio Borio. He has been the head of Monetary and Economic Department, MED, of the BIS since November 2013. At the BIS, since 1987, he has held various positions, including Deputy Head of MED, Director of Research and Statistics, as well as Head of Secretariat for the Committee on Global Financial System and the Gold and Foreign Exchange Committee. From 1985 to 87, he was an economist at the OECD. Now, Mr. Piti Disyatat is Assistant Governor of Bank of Thailand and also Executive Director of Pui Ung Pakon Institute for Economic Research. Prior to his current position, he worked in various areas of the Bank of Thailand, including the financial risk management, foreign reserve management, and monetary operations. He also worked as a senior economist in MED in the BIS in Basel. Before joining the Bank of Thailand, he also worked as an economist at the IMF. And finally, former Mochtar is Executive Director of Bank Indonesia. Before he took up the current position, he worked in various senior positions at the Bank Indonesia, and also worked at the IMF as an advisor and also BIS in Basel as an economist. So let me start the session in organizing about 2 rounds. I think that's probably good for us. So the first round, let me ask the panelists to focus a bit more on the big picture, such as what's sort of a concept and what's the sort of a big framework that has been developed within each central bank or each institution so far. And then in the second round, let me just go into a bit more detail about the implementation or operationalization aspects. And there can be many questions about that, especially what's sort of unique for EMEs compared to other jurisdictions, which also think about the IPF in different contexts. So those are the big plan. And maybe I can start from the first round and ask Pierre-Olivier to give you sort of views about the big picture questions about the frameworks.
Well, thank you very much, Ilhyock, and it's really a pleasure to be here. Thank you for inviting me to this high-level dialogue on the operationalization of the frameworks for integrated policy. And I will talk about what the work we've been doing at the IMF, but the work we've been doing in the past, and also our planned next steps. Now, I want to emphasize this is a very important topic for us at the IMF, that we just updated our executive board in June, and we're very happy to be in outreach and listening mode here. Now, to answer Ilhyock's first question, I will take a step back and provide a little bit of perspective on what we're trying to accomplish when we're talking about the integrated policy frameworks. Now, at the IMF, the IPF was initiated a few years ago because we recognized that policymakers often face difficult trade-offs, policy trade-offs, in pursuing domestic, external, and financial stabilization objectives. And cross-border capital flows provides benefits, but may also generate or amplify shocks. And so in that sense, I think the approach and the perspective that we are pursuing is very much in line with what we heard from the governors in the first session earlier today, and very much the objective that we're pursuing as well. Now, these trade-offs are particularly pronounced in emerging markets and developing economies, although they are also relevant for small, open, advanced economies too. Now, the work we've done builds on frontier developments in both the academic literature and in practical policymaking in regions across the world, including Asia. And the IMF framework covers traditional tools, such as monetary policy or exchange rate flexibility, but also covers additional tools, such as macroprudential measures, foreign exchange interventions, and capital flow management measures. Now, fiscal policy has also been added to the mix more recently, and there is ongoing work on that. And the framework draws on both modeling, empirical analysis, and case studies, and some of these case studies, we'll come back to that, have been conducted in some Asian economies and other countries as well. Now, a major achievement of the IPF is to allow us to understand systematically the conditions under which we need to move beyond the simple Mundell-Fleming ISLM policy prescriptions to achieve macroeconomic and financial stability. And therefore, our recommendation, not surprisingly, in a sense echoing a little bit what Governor Sethaput said earlier today, do not take the form of complete reliance on exchange rate flexibility under all circumstances for all countries, as the traditional Mundell-Fleming framework had recommended. And conceptually, the reason we reach a different conclusion is because we have a richer framework, one that includes financial frictions that are not in the traditional sort of textbook analysis. And specifically, we focus on three important sources of distortions. One is that countries may have relatively shallow foreign exchange markets, so that there can be large disruptions in exchange rates when there are relatively small transactions or small capital flow movements. The second is that countries may face currency mismatches, and those currency mismatches can generate balance sheet problems, and those balance sheet problems can then have macroeconomic and financial stability consequences. And the third one is that countries may also have relatively high pass-through of exchange rate movements into inflation, and that could contribute to de-anchor their inflation expectations if you have a particularly large movement in the exchange rate. And all of these three things are things that are not part of the standard framework, and that we've worked to include in our analysis. And the IPF, in our perspective, what it does and what it's helpful for is to clarify the conditions under which tools may or may not be appropriate. And so let me say a few things on this, because I think it's important to understand what we get out of this and what we don't get, and then what are the limitations, and then we can talk in the second round, we can talk about implementation. The first sort of, in a sense, relatively obvious result is that if the financial frictions I've just mentioned are relatively small, if they're minimal, then we're going to fall back on the standard result. And therefore, full exchange rate flexibility remains optimal in a number of situations for a number of countries. The second important result is that even if you have these frictions, it does not necessarily imply automatically that you want to use all the instruments you have at your disposal. There are many cases where standard monetary policy and fiscal policy instruments are the best tools. either because the shock is a fundamental shock, or, and this is also relevant because there can be very large side effects from using FX interventions or capital flow management measures. And some of these side effects may be, the side effects may be worse than the medicine. For instance, you might be depleting your reserves very fast. You might be coming close to the point where you deplete your reserves very fast, and that could in turn generate adverse market reactions. Or the excessive use of instruments could also affect market developments. For instance, the ability of the market to develop hedging instruments, which is a desirable feature. But under certain conditions, it becomes appropriate to have either FX interventions or even capital flow management measures. And that's something that the framework allows us to think about. So in that sense, the position of the fund, I would like to summarize it the way our managing director, Kristalina Georgieva, often used this sentence. She says, well, this is not your grandmother's IMF. And so in a sense here, we are really looking beyond sort of the very simplistic nature of the models we used to work with maybe 20 years ago, and we're in much more detailed and granular type of policy prescription. And in addition to this role for FX interventions or capital flow management, there can also be a preemptive role for these type of instruments to help prevent the buildup of financial vulnerabilities. Another important takeaway from our analysis so far is that it's not anything goes, because we have multiple instruments and we have multiple objectives, macro, domestic and external, and then financial stability. We're going to use everything all the time. That's not the case either. As I've mentioned already, if the frictions are relatively low, you don't want to use some of these instruments. You want to rely on macro and fiscal policy, and you want to let the exchange rate adjustment help you and buffer you against external shocks. There are situations also where the tools could actually do more harm than they do good. And I'll come back to that when I'm talking about the pilots in a few minutes. But let me stop here, maybe in terms of the broad overview.
Okay, thank you. Let me now turn to Mr. Claudio Borio. I'm sure he's online. So let me check. Claudio, can you hear us? Yes, thank you.
I can hear you. Can you hear me?
Yes, I can hear you.
Okay, all right. So, well, first of all, before I say anything, I do apologize for not being there with you. It was absolutely impossible for me to do so this time of the year, given that we are preparing as Ilhyock knows full well, we are preparing the bi-monthly meetings of governors in early September. But obviously, I'm extremely grateful for the kind invitation. And I'm especially pleased about the invitation because I will be talking about an issue which is very close to my heart and which has accompanied my professional career on and off in various guises, I would say for about at least a couple of decades now. Now, the session is on operationalizing the integrated policy frameworks, or as was mentioned in the previous panel in BIS parlance, macro financial stability frameworks. And this, of course, is an area in which the BIS has written extensively over the years, alongside the IMF, a G20 report, and then we have importantly collaborated with central banks in the region to write a couple of reports. I will also give the issue a little bit of a personal spin, given how much, as I said earlier, it's really close to my heart. So let me start by giving a sense of when the whole thing started, if you like. And in fact, it started many years ago, roughly in the mid-2000s. And that at the BIS, and that was the idea. It was based on the recognition that tectonic policy shifts around the world since the mid-1980s had been fundamentally changing the nature of economic fluctuations. Financial liberalization, both domestic and international, had greatly increased the role of financial factors in driving the economy, hence the financial in macro financial stability frameworks. I like to use that phrase of Saccomanni and Padua-Schioppa, who said that by 1994 we had shifted from a government-led to a market-led global financial system. Second, globalization of the real economy was a powerful disinflationary force, helping central banks bring down and hardwire low inflation. Now, the key implication of all this is that, we explain it again in this year's annual economic report in chapter 2, is that as a result of all this, inflation was no longer a reliable or sufficient signal of constraints on sustainable economic expansions, and that financial booms had taken over that role. And by financial booms, I mean in particular very, very strong increases in credit, in asset prices, particularly property prices, restaking, what we at the BIS have called the domestic, let me stress, domestic financial cycle. So we had shifted from inflation-induced to domestic financial cycle-induced recessions. So recessions were no longer the result of monetary policy tightening to quench inflation, but largely spontaneous, or the result of a spontaneous unwinding of financial imbalances. And again, let me stress, the focus at the time was very much on advanced economies and less so on purely on emerging market economies that have certain specific features, and I will come back to that. So the implication of this was that there was a role for monetary policy also in restraining financial booms and busts over above short-term, and again, let me stress, short-term inflation control. There was a big role, it was very important for regulation and supervision to shift from a purely micro prudential perspective to a macro prudential perspective that is a stronger systemic focus, system-wide focus. And it was also important for fiscal policy to recognize that financial expansions can generate large contingent liabilities that would materialize only if you had recessions and possibly financial crisis later on as the financial booms turned into busts. Now, because of the advanced economy focus, we had not really stressed so much something that would become extremely important, as we heard later on, which was the role of capital flows. What I would say later on had come to be discussed under the label of the global financial cycle. Now, of course, these capital flows became much more important precisely because of financial liberalization and are of special relevance for emerging market economies. The ebbs and flows of global financial conditions that have a big impact on domestic financial conditions as a result of the factors that we already know, in particular, rather shallow financial markets, and therefore also fewer hedging possibilities, currency mismatches, either on the borrower side or on the lender side in portfolios, in those that are actually investing in emerging market economies. So our conclusion was that emerging market economies, and we analyzed this in particular, I would say, in a chapter in the annual economic report that came out in 2019, which very much highlighted the role of foreign exchange intervention and capital flow management measures. But within this integrated framework that was also looking at the domestic side. Now, our conclusion at the time was that emerging market economies, and particularly those in Asia, were already in many respects implementing policies consistent with macro financial stability frameworks, at least from a philosophical, if you like, a principle perspective, but they may not have been using them in a kind of holistic way, or if you like, having developed the frameworks from more of a specific analytical perspective. So this was very much practice ahead of theory. And I have to say that at the time, within the academic world, there was work, but these issues had not become an integral part of the standard frameworks being used. So let me stop here.
Okay, thank you, Claudio. Now let me ask Piti to share your views.
Thank you, Ilhyock. And, it's a pleasure to be here and be part of this distinguished panel. Let me just take a step back and say from our experience, actually, if you think about the underlying motivation for this integration of policy for us and for most central banks is to deliver macroeconomic stability. Now, since the 97 crisis, it was very clear to us, at least, that to do so, it is critical that we take into account exchange rate fluctuations, as well as financial stability, both on the borrower and lender sides, into how they feed into the macroeconomic picture. So since the very beginning of our inflation targeting experience since over 20 years ago, there was a prominent feature. And, you know, it's not uniquely Thai, it's also, I think, an ASEAN feature of this flexible inflation targeting framework that we have practiced for a while now. So what does that entail in practice? I think there's two key elements. The first one is analytically, you must have a framework, a model that can bring together these four key elements: output, inflation, exchange rate, and financial stability, how they connect and interact with each other. That's on the modeling side. In the second part is operational. You know, we had to utilize all the tools that was available to achieve, I think, the best outcome that was possible. So from very early on, you know, FX intervention was part of our toolkit in terms of our managed float. We did macroprudential way back. We had the LTV measure already back in 2003. And we had some experience with capital flow management measures as well. So it's no surprise that the IMF, you know, picked Thailand as the first pilot case for the integrated policy framework a while back. And so from that perspective, you know, this integrated policy framework is more a continuation of a long tradition in Asia and in ASEAN in particular of taking into account all these moving pieces in one integrated, at least holistic manner. And what's new, I think, is the technology in terms of the modeling has kind of caught up and is helping to frame the discussion a lot more. Operationally, I think the framework and especially the governance structure has become a lot clearer. How do we apply this? So yeah, let me just end quickly there in terms of the big picture of how we view this framework discussion.
Okay, thank you. So now, Firman, please.
Thank you, Ilhyock. Also, an honor for me to join this prominent panelist. So, actually, my remark will be the same. It's easier for me because it's already mentioned by other panelists. But let me share 3 points, our motivation, why we are implementing this kind of integrated policy framework. The first one is, of course, because this small open economy is exposed to the global situation. It's not only related to the financial channel, but also the trade channel. Like Claudio mentioned, the capital flows can go easily and come out easily from the economy. And then this kind of movement can make exchange rate, which is conceptually could be shock absorber. Now, if it is not managed, could be kind of a shock amplifier. So this is one of the motivation for us related to the global situation, which we should isolate it from them. The second thing is also mentioned by other panelists. It's related on how is the financial market development. This make another issue, like mentioned by Claudio, when inflation is not sufficient to sustain the economic growth. In this issue, then we have to also address how is the macro financial linkage from the financial market to the economy. And then the third one is why we also employ this kind of framework. It's related on the country specificities. So it's different when the advance or other based on the textbook, when everything market efficient. the country specificities is going to be different. It's not only related to the goods market, but also to the FX market and also money market. Related to the goods market, as mentioned earlier by Governor Perry, when the flow of goods is going to be really different, can easily to raise the inflation from the volatile food. This is very important. The second thing on the money market, of course, when the market is very segmented, then it should be addressed differently. The third thing is about the FX market. When the market is very not really deep, then it's really easy to be fluctuate to among others. So given all those three factors, we implement this kind of integrated policy framework. It's not only related to the monetary policy, which is not only solely depend on the interest rate, but also how we are trying to implement the FXI to mitigate the volatility and also to maintain the imported inflation. And also how we are trying to preserve the reserve adequacy, which is could be kind of the second insurance for the economy. And then another thing for the macroprudential, we are not only related to maintain the stability, but how we are to try to balance between to have a optimal lending and also how trying to be part of the supportive for the inclusive growth. So those are related to for the macroprudential. The third one is how we are coordinate with the government, because the shock, especially for the inflation, is not solely coming from the demand shock, but also coming from the supply side, which is going to be easy if the government can be a part of the team. And all in all, how we operationalize it, right? So like Piti mentioned, actually we already have those kind of a core model, which is starting from micro founded, but it's going to be hard sometimes when we want to figuring out the situation. So the model will be a kind of a hybrid model. And then given the second thing, we also trying to establish kind of a satellite model, which at least can capture on the non-linearity of the situation. And then the third thing, of course, it could be supplemented by leading prompt indicators. And the last important one is about professional judgment, because we believe that the model doesn't make a forecast. The people will do the forecast. Thank you.
Okay, thank you, Firman. So listening to all the four panelists, I sort of see a few common things. One is this concern about relatively shallow FX or more generally financial market versus huge amount of global financial, either shock or flow, whatever you call. And this is sort of fundamental tension is there from many EME point of view. And then I guess the second sort of related question is whether you can call financial frictions or it can be some sort of incomplete functioning of the prices, I would say. Those prices sometimes become more like an amplification device, and that sort of seems to worry a lot of EMEs, which depending on the context can be very different country by country. So based on that, maybe you can quickly move on to the next one. So now thinking about all those big picture questions in terms of actual implementation context, what can be potential challenges? Either it can be more like conceptual still, meaning the fundamental challenges, or it can be more country-specific, case-by-case challenges, and especially in the context of EMEs. So for this kind of second round, let me ask Claudio to speak first, and then I'll ask Pierre-Olivier to follow. So Claudio, please.
Well, thank you, Ilhyock. I would say that here there are two different types of implication from what I said earlier that can help you, can guide the implementation of the frameworks. The first is really a big picture one about the underlying philosophy of macroeconomic policy. And the second has to do much more with the nitty-gritty of integration. Now, in terms of the underlying philosophy, and here, of course, you have to go a little bit beyond specific models. Here, the idea is that the perspective that I have outlined puts a premium on prudence and realism based on a keen recognition of the limitations, if you like, of macroeconomic policies. And the key word here is, I would say, safety margins and buffers, hence the importance of prevention in this general sense. Now, in this year's annual economic report, in particular, again, chapter 2 is the one that develops these ideas. We argue that the progressive loss in the room for policy maneuver in both monetary and fiscal policy until the recent inflation surge, and that surge itself has been to a considerable extent the result of a failure to appreciate fully the intertemporal trade-offs involved in the type of economic fluctuations that we have seen and the policy challenges that they raise. That is, how actions that may appear reasonable or indeed very much compelling in the short run can generate problems down the road. If you go back to what I said about changes in the nature of the business cycle, monetary policy felt that it could push on the accelerator as long as inflation remained low and below target. And fiscal policy felt that it could expand with little restraint because interest rates would remain low as far as eyes could see. So the terminology that we use is that monetary and fiscal policy had been flirting with the boundaries of the region of stability and at times had drifted outside them. And at times, before the change in the nature of economic fluctuations, the key signal that they were moving outside or drifting outside was inflation. And then it was financial instability. And most recently, if you like, has been a mixture of the two for reasons that we could go into. Now, this region of stability, therefore, defines the policy settings consistent with sustainable macroeconomic and financial stability for monetary and fiscal policy, and which can keep the tensions between the two manageable. Now, recall how even before the COVID crisis struck, government debt to GDP ratios were already at historical peaks, how nominal interest rates were at historical troughs, and how central bank balance sheets had reached levels that were in line with previous wars. So you can think of what we did in the annual economic report this year, and which I cannot, of course, elaborate on, as precisely trying to see how you can integrate fiscal policy very much in this framework, thinking in particular of its interaction with financial stability. Now, let me turn to the much more specific implementation challenges or integration challenges. And I think that you heard some of this already in the previous panel, but I think it's important to lay out the specific challenges a little bit more. The first has to do with, I would say, the different rhythm of the underlying economic processes that constrain economic activity. And this effectively constrains how much you can actually go in integration. For example, the domestic financial cycles that I mentioned earlier, credit, asset prices, risk-taking in the domestic sphere, particularly property prices, which are so prominent in financial instability. Now, they have a duration which is much longer than that of the typical business cycle, at least as we traditionally measure it and as economists measure it in policy making. By contrast, the global financial cycle, this ebbs and flows in financial conditions, tend to move pretty much in line with the domestic financial cycle, not least, of course, in response to policies in core countries, particularly the United States, which is, if you like, the director of the orchestra. And the risk-on and risk-off phases in financial markets, which are the main drivers of higher frequency changes in currency swings, in currencies and in exchange rates, are of a much shorter duration. Now, these differences in duration of these cycles set different horizons for the various policies. For example, that of financial stability, a financial stability-oriented macroprudential policy, which deals with the domestic financial cycle in particular, not only, is much longer, the horizon is much longer than that which monetary policy deals with or fiscal policy typically deals with or thinks about it in the context of inflation or short-run macroeconomic stabilization. And that of FX intervention is even shorter. It sort of has a horizon of about a day, even intraday, and so on. Moreover, these differences that have to do with the underlying economic processes are enhanced, are amplified by differences in implementation lags. For example, for institutional and political reasons, they're much longer for macroprudential policies or indeed macro or capital flow management measures than they are for monetary policy. So in many respects, I would argue that monetary policy is the policy that can adjust most easily given its nimbleness. It can take macroeconomic and fiscal policy settings into account, and it can lengthen the horizon in order to internalize some of the financial stability considerations that I mentioned earlier. Now, and this is very, very important. Regardless, it is critical to incorporate such longer-term horizons in all policies, because shortening the horizon, for example, trying to use macroprudential policy very much with short-run macroeconomic stabilization objectives, I think in the end would exacerbate as opposed to alleviate some of the intertemporal trade-offs that I was mentioning earlier. Now, what are the possible practical steps to improve the integration of these various policy tools? Again, keeping in mind the limits to this integration. Let me mention a couple. One, of course, is, as we heard before, better analysis. I think we need macroeconomic models that better integrate the financial sphere and take into account this endogenous financial and business cycles that I was mentioning before. And some progress has been made in that area. Then from a more practical perspective, I think we include a battery of tools to help us identify the buildup of vulnerabilities, both domestic and external. And again, some progress has been made in that area. The second important domain is that of better governance. And as we heard before, it is important to have better governance within policy institutions, for in particular central banks across different departments. And as Governor Setaput mentioned, something that I have struggled in my professional career, and I have found rather frustrating, has been to see how those that work on, or at least for many years, have been working on the macroeconomic side and have been providing advice for monetary policy, and those that have been working on the financial side and have been providing advice for supervision, be it microprudential supervision or more even broader financial stability aspects, really have been thinking in very, very different terms. And it's only recently that we have made progress in trying to integrate these two different perspectives. Now, from a practical perspective, as I mentioned earlier, take for example the FX intervention. I think that there is scope. I think that there is scope with an analogy with what happens with portfolio allocation, to think of distinguishing between a strategic perspective and a tactical perspective and try to integrate the two more clearly. I think this is an area where I think further thinking should be given. And then, of course, across different authorities, central banks and prudential authorities, if they're not in the same institution, and of course the government, as we heard before, but these are old issues that we're all familiar with. But let me just leave you with an overarching thought. And I think that it would be unrealistic to wish for a cookbook to operationalize a macro-financial stability framework. Each country has to find its own way to mix the various ingredients. So let me stop there.
Thank you, Claudio. Now let me ask Pierre-Olivier to also think about the challenges, especially for EME context, if possible. Thank you.
Thank you. Let me organize my remarks in three parts here. And I want to start first with the very important question of the challenges related to the implementation of the IPF, something that Governor Setup asked us to talk about in the second session. And here we leave fiscal policy aside. It's a very important issue, the question of fiscal and monetary policy interaction. And of course, to some extent, that should also be part of the integrated framework. But but I want to focus more narrowly on the monetary and financial side. So thinking about monetary policy, FX interventions, and the capital flow management or macroprudential measures. I think the first observation I would make here is, even with just that narrower integrated policy framework, it's already incredibly complicated. The way I would describe it is, what made the Mundell-Fleming framework so successful for so many years is its simplicity. You could teach it to undergraduates, you could teach it to master students, and then once you had grasped the key concepts, you could carry that, this diagram in your head and instantly think about what would be the effect of monetary policy and fiscal policy under a flexible exchange rate, and think about the effect of, fiscal policy under a fixed exchange rate or devaluation. And you would get an answer that would be substantive and interesting. It's very hard to do the same thing once you have multiple instruments and multiple objectives and financial frictions, etc. So a first part of really helping policymakers or the colleagues at the IMF or people in the profession understand what's going on when you have all these different instruments is to come up with ways of simplifying it so that you can convey the key insights. And so we're doing a lot of work at the fund on this communication of the framework, simplifying it, and if you want, finding the equivalent of the Mundell-Fleming representation. And I think that's very important. Once people grasp it, then it's much easier to have a conversation about, well, okay, now let's talk about how much do I need to use that instrument versus that other instrument. The second aspect in terms of implementation, which is also very challenging, is in assessing the shocks and measuring the frictions. Now on this, at the fund, we've done a lot of work in developing a metrics database where we try to think about measuring the shallowness of the FX markets, measuring a currency mismatch, measuring the degree to which inflation expectations may or may not be de-anchored by exchange rate movements. But this requires very granular data. This requires a lot of inputs, and we've made some progress, but we're not entirely there. The third part of the implementation is, once you have sort of the simpler model in the back of your head, once you have the good data, you have to translate findings from the models, calibrated models, quantitative models, into policy formulation. And that is also something that is difficult. I agree with what Claudio just said, and something that was also said in the first session. I don't think we're going to have something where we have a combination of, say, Taylor rules plus, where we have a Taylor rule for the policy rate, and we have the equivalent of a Taylor rule for FX intervention, and maybe another rule for other types of instruments. I don't think we're quite going to get there. I think there is going to be a role for judgment. I think this is going to be an ongoing conversation, but the models help in shaping the contours of the discussion and realizing what the trade-offs are and where they might be acute and where they might be less acute. And all of that also requires, and that's the last step, requires building specific models calibrated to country specificities, and coming with that sort of capacity development in modeling at the country level. So all of this is quite substantial in terms of challenges that we're looking at, but we're already well on our way. And I think the pilot programs, Thailand and Indonesia and Malaysia and Philippines have been very, and along with other countries in other parts of the world, have been very, very useful in helping us understand how we can do that. An important other challenge, which I think is critical when we think from the perspective of policymakers, is that in the models have shocks, and these shocks come with names. There could be a commodity price shock, there could be a supply shock, there could be a fiscal policy shock, there could be a non-fundamental shock, something that has to do with the willingness of global financial markets to intermediate the demand for currency. In the real world, you see things happening and they don't come with neat labels on them. You don't know what hit you until maybe a long time after it hits you. Think about the discussions we're having about the sources of the rise in inflation globally. demand, supply? Is it due to the supply chains? Is it due to the fiscal policy? Is it due to the energy component? We're still having these discussions. Now, of course, the dust is settling, but in the heat of the moment, you have to make a decision, and to make that decision, the model is useful to the extent that you can really put labels on the shocks. And we're not in that position very often. So what that means is that we need to also think about how to do that signal extraction, and then how to develop robust policies. Policies that are going to be robust to potentially being wrong in the identification of the shock. Or being robust here means being the least wrong possible given the configuration of shocks that we're likely to face. It doesn't mean being right necessarily, but being the least wrong. And I think that's an important shift in terms of the focus to be having this sort of risk management approach when we're using this type of models. And that's also an area where we're doing some work. Now let me get to the second part of my answer, which is what are the specific challenges for emerging markets when we're thinking about the integrated policy framework? And I think obviously what we're seeing when we're looking at all the pilots we've been conducting is that emerging markets often, are facing one and often more than one of the frictions I've mentioned, the shallow FX markets, the currency mismatch, and potentially the pass-through from exchange rate movements to inflation and inflation expectations. And in doing the pilots, this has been tremendously helpful in helping us refine our understanding of what is going on in a number of countries. So for instance, what we've realized is that the depth of the FX market is something that can be time varying. That's something that was mentioned earlier today. There can be times when everything looks fine. You can have big movements in capital flows and the market is willing to absorb them, and you get relatively small movements in prices. That's a deep market. But you can then all that liquidity can dry up very quickly, and then you end up with a shallow market. You don't have a lot of water under your keel, and then small movements can generate sharp exchange rate responses, and that has big consequences. And that's something we've seen in a number of the pilots, especially in ASEAN countries that I've mentioned already. Now, another important lesson is that we found that both from our conceptual and our quantitative models, that some frictions suggest that some instruments are better than others. And the optimal mix really depends on the shock. And so, for instance, FX intervention is typically better for what we call risk-off shocks than fundamental shocks. When you have a risk-off shock, FX interventions are going to directly, in a sense, neutralize what that risk-off shock is doing to for instance, your uncovered interest parity, so the spread that arises between domestic and foreign pricing, that is going to be directly addressed and reduced and absorbed by FX intervention in a way that it wouldn't necessarily happen with a fundamental shock. And the interaction of policy tools is also something that is important, and something that came up in the pilots we've been doing in emerging markets. So for instance, FX interventions in some case can help reduce the risk of inflation de-anchoring if it's used judiciously alongside monetary policy. Again, that's a lesson from some of the pilots we've been conducting in the region. But at the same time, what we're seeing is that some forms of ex-ante regulations, for instance, on corporate external debt, that's the type of measures that have been put in place in Indonesia, for instance, here, may help reduce the case for FX interventions ex post because they reduce the currency mismatch, they reduce the FX mismatch. So we have interesting interactions between different instruments and policies from an ex-ante perspective and ex post, and I think we need to set up, of course, the work conceptually, but then go to the case studies, see what works, what doesn't work, what has been done, and what we can learn from that. Now, our pilots also show that in some emerging markets, the traditional policy mix is still the best option. That's something I've mentioned already in my answer to Ilhyock's first question. So, for instance, in some cases, the financial frictions don't appear to be strong enough. We've seen that in a number of other pilots we've conducted, for instance, in Colombia or South Africa, or there are high costs of using FX interventions, in the case of Uruguay, for instance. And sometimes FX interventions can be counterproductive. Let me give you an example. If you have an environment where some of the shocks are driven by policy uncertainty, And this policy uncertainty is driving up risk premia, is driving up premia in the market. Introducing FX intervention may not reduce the policy uncertainty. In fact, it might exacerbate the policy uncertainty. So you end up having a policy that instead of solving the problem can exacerbate it. And we've seen situations, for instance, in the case of Colombia, where that might have been playing in that direction. Now, let me say a few things about the planned work at the IMF in terms of where do we go from there. And I think first, you know, this is something where we're taking all the lessons from the pilot programs we've been doing. We're going to be updating our note on the principles and use of FX interventions, for instance, and that in light of these pilot experiences, and that will be circulated to our executive board, and that will be published soon. But beyond this, I think there are a couple of important things we would want to think about. One is communication, coordination challenges in multi-instrument frameworks. And I think this is a point that was also made in the first session by a deputy governor of the Bank of Philippines. The point being here that when you have multiple instruments, it becomes more complicated to communicate effectively. That's something that is very, very important. Central banks have tremendously improved their monetary policy framework over the years in terms of governance, in terms of transparency, communication. If you throw in a bunch of other instruments in there, you sort of have to start from scratch in those other dimensions. So that's something where you want to be very careful how you do that. There is a need to continue to work on refining the quantitative models, as I've mentioned, sort of include more frictions, include frictions that are calibrated more effectively to country specificities, and also work on having robust diagnostics. So making sure that the kind of policy recommendations that come from that is going to be robust to potential misdiagnosis to the extent that it's possible. But at the end of the day, let me conclude with just one more remark. All models are imperfect. As I said, models are providing a contour within which we can have a conversation, you know, between the fund and the authorities about what the right policies might be. At the end of the day, the countries, of course, are making their decision in terms of policies. And I think that conversation is very important. And sort of cooperation between country teams, between authorities is really crucial in this regard. But we also need help from the countries themselves to refine our own tools. A key area, for instance, is continued collection of data on frictions that are relevant, or data also on the kind of policy decisions that have been made at country levels, on the use of FX interventions, for instance, etc., so that we can incorporate that into the models, and that can help provide more refined assessment of the policies and more guidance. So thank you for your attention and your engagement. I mean, this is a very important part of our work at the IMF.
Okay, thank you. So after listening to the rather broad international financial organization view, maybe we can switch to more country-specific view. So maybe I'll ask Firman to start first. So what are the specific challenges when you think about this implementation of tools? Yeah, I guess your Governor Perry already mentioned some challenges, but I think since you're working the more the working level, so I'm sure you can share more your insights.
Thank you, Ilhyock. So, learning from our experience, at least there are 3 challenges. The first one is how is our reading on the type of shock, whether it is permanent or temporary, whether it is structural or cyclical, or whether, as mentioned by Pierre and Claudio, whether it's coming from supply or demand shock, whether it is coming from the real or nominal shock. So our reading on those shock will affect on how is our response later in terms of timing, magnitude, and speed, and also the choice of the instrument. That's the first challenge. The second challenge is how is our reading on the economic circumstances itself. As I mentioned, is how is the development of the market, goods, FX, and money market. The most important thing is also in this part is how is our reading on the financial and business cycle. whether it is still going down or in accelerating trend. So those two cycles will interact to one another and will affect once again on our type of instrument choice. And one thing is about the reading on national circumstances is about the national institutional arrangement. So this aspect will affect who's doing what. And the central bank should be committed on the stability, not only for the inflation, but also financial stability supporting the growth. The third challenge is related on the how is our reading on the impact of our policy response itself, whether it can be interact to household, corporate, and also to the financial market. So this kind of interaction will affect on how is our choice on those, especially on the what's so-called risk-taking channel, right? So it's amplify the shock and then whether we are trying to make it. So overall, those three challenges will affect on how our setup on the policy response. Once again, the timing, speed, and magnitude, and also the type of instrument. Because otherwise, it's going to be hard for us to have this imperfect market friction, and is a guessing how is the lag, how is the transmission. How do we overcome this? Of course, we are trying to calibrate on all of our model. It's not learning only from the model we already have, but also trying to see the prompt and leading indicators. The one thing that would be challenged is, the second thing is we also coordinate with the government and other stakeholders. The third thing is, this is a big challenge, is how do we communicate our policy response? Because as mentioned earlier, monetary policy should go for the stability, while other policy like macroprudential, they can go for the growth with a targeted and then transparent response. Given all those two different stance, sometimes market and people see. So what is the objective? So this is the role of our policy communication and sharing with them. So there are some friction, there are some imperfection, but we believe given the situation, suppose it can accelerate, it can support for the growth. Eventually, it can also help the stability at the request. So yeah, I think I'll stop for me. Thank you.
Okay, thank you, Firman. Finally, Piti. Yes.
Thank you, Ilhyock. So practical challenges, boy, where do I start? We have to actually do this for real, and there's so many things I can complain about. Let me start, and as you know, I work a lot with Claudio, so we may have some overlaps in our conclusions. But firstly, in terms of just the decision making, ideally it would be so nice if you're a central planner, you have all the tools, all the information, and you can optimize everything at the same time. But in fact, decision is made sequentially, right? And by different bodies. The MPC for monetary policy, another body for macroprudential, and sometimes another body for CFM and FX market. So it's really hard to actually optimize jointly. It's optimized like taking as given other policies, and that's quite difficult. And what ends up happening, I think the way we resolve it is actually most of the internalization is done by the Monetary Policy Committee. It's the body that takes the most macro view of the economy and can take this longer-term horizon. So that's one thing that, for example, with our LTV measures, we actually had the MPC recommend some of the the adjustments to that. Secondly, in terms of like what policymakers, the expert judgment that people talk about, what do they have to overcome? I think there's three elements or three phenomena that's really difficult in managing macro financial stability. One, as Claudio mentioned, is the intertemporal trade-offs. This includes both the direct effects of policy, for example, low interest rates leading to higher debt that bites back in the future, and also indirect from the effect of policy on expectations. If you intervene a lot in the FX market, people adapt to it and they may not hedge. If you implement low interest rates for a long time, people adapt to it and they maybe not hedge against interest rates exposures. So that's the first thing. The second thing is non-linearities. Things are stable until they are not. So the accumulation of stock imbalances just kind of hit you all of a sudden. And thirdly, spillovers or externalities. This can be across instruments, how monetary policy affects financial stability, and sometimes macroprudential affects aggregate demand, as well as spillovers across countries. And here I'm thinking mainly about what we went through last year with the global tightening of monetary policy. The global effects of that, no one is really internalizing. So with those three phenomena that policymakers have to use judgment on, I think some of the guiding principles that I think both the governors and Claudio already mentioned, one is to have a medium-term orientation, look through the noise and focus on the longer-term impacts of your decision-making. Second is to have buffers to cushion against unforeseen shocks. And thirdly is to have coordination as much as you can, especially in terms of across the bodies that calibrate the instruments. Ideally, you would want the instruments not to work against each other, but actually complement each other. Not one body stepping on the accelerator, one stepping on the brakes. So I think that's one of the main challenges. And just to get back to what Pierre-Olivier mentioned, another more practical challenge. This is both an analytical one as well as a practical one. How do you model the policy rules for these alternative instruments? For interest rates, we have the Taylor rule. It's pretty clear how to interpret output gaps and inflation gaps in how you would react. But when it comes to FX intervention or macroprudential, the first step in extracting the signal from the variable is very difficult. For example, FX intervention is typically modeled as change in reserves as a function of something, right? That could be the change in exchange rate. It could be the volatility of exchange rate. It could be the real exchange rate gap. And you don't really know how to interpret those signals because the benchmark is not very clear. Also, with the macroprudential example, typically in the models, it's the instrument is modeled as a linear function of some variable like credit growth or maybe credit gap. But in fact, in practice, policy doesn't vary in that systematic linear way. It's more like a discrete choice situation where once you get to some threshold, you act. And so there's a lot of bunching. You go for a long period of time where nothing happens, then in a short spurt, many things happen. So again, it's very hard to extract signal. How much is credit growth? When is it too much? Or the credit gap? Echoing what the governor said, it's really hard to get the signal in terms of how to judge the policy response. Let me stop there for now.
Oh, thank you. So, listening to all those sort of challenges, you can sort of think about these four objectives, right? Price, business cycle, external, financial, and then how many tools you can think about? Maybe 10. So 4 times 10 is a big matrix, and things cannot move in the same direction, mainly because of the different cycles and also different shocks, all the trade-offs, frictions. So you can imagine this is almost impossible. I think that's the communication issue should come out because of this complex 4 times 10 dimension plus different cycle and how you communicate, and then horizon, right? So I guess the whole sort of landscape is extremely complex, but still central bank or other authorities want to communicate. They are trying to figure out the best mix, and they should agree. But in a sense, to me, this idea of difficulty of coordination also comes from difficulty of mandate, different mandate and cycles. Right? So this all things are connected to me in a sense. So I guess the difficult part is how can we explain and how can we think about the margins of different choice, choosing different choices based on different shocks. So in that sense, I think we sort of covered all the major sources of difficulties in that case. So then my sort of one question to panelists is, so last year was sort of mother of oil shocks happening at the same time to EMEs. We had a supply shock and also dollar strengthening at the same time, growth slowing. So have your sort of thinking changed after experiencing what happened to 2022 compared to what you have been thinking about this bigger framework up to 21? So if panelists can share what is a major insight you learned from last year's experience going forward. Maybe I can start from Pierre-Olivier, then.
Yes, I mean, it's hindsight is 2020, but we're not yet with full hindsight. So I'll just offer a couple of remarks on this. And I think in doing so, I will also touch on some of the three main things that I think came from the first session, but also from the remarks by the other panelists, Claudio and everyone else. So when we think about, there's a question about what happened and what drove inflation up and supply demand, etc. But leave that aside for a minute. It's very clear that at some point it was not possible for central bank to just sit and do nothing. Standard prescription for a supply shock, if it's going to be very temporary, is just, just let it go through and you don't necessarily need to adjust. You get a shock that is more persistent, you get an elevation in inflation that is going to last for a while, then you're playing with fire. You could de-anchor your inflation expectations, you could get into wage price spirals, you could get into a situation that is very unpleasant. So it was very clear that major economies, central banks had to increase their policy rate. So start from that, and now let's ask, okay, well, what does it mean for EM? And let me add one other thing to that, which is, of course, the energy price shock that comes from Russia's invasion of Ukraine and the dislocation in gas market, liquid natural gas, which has an impact in Asia in particular, because of the increased demand from European economies and also in oil prices. So you get both the energy price, you get the economies reopening from COVID, both of these things pushing towards tightening of monetary policy. Now, the standard textbook approach would be the same. These are fundamental responses to a change in the environment. And therefore, there is a need for relative prices to adjust. For some countries, relative prices need to adjust because they suffered a negative terms of trade shock. Energy importers suffer negative terms of trade shock. And for others, it's just because there is more tightening in advanced economies than they need to tighten themselves. Their inflation dynamics is not the same, and therefore there is a need for an adjustment in relative prices. So that's where you start. You start from this observation that is based on the fundamental analysis. Then you start asking yourself, okay, well, but what we saw is a very rapid appreciation of the dollar against most emerging market economies. And the speed of that appreciation is in itself potentially a problem for a lot of countries. And this is where we saw a lot of, Asian emerging market economies, but also others looking at this and saying, okay, well, we need to lean against the wind. We need to do something to prevent an appreciation that would be too rapid in a context in which capital markets could become very nervous, liquidity could dry up, the markets could become shallow. And so that in that context, I think this is where the IPF can be incredibly useful, because by helping to calibrate the extent to which you're vulnerable to this type of illiquidity in your FX market, you're vulnerable to the risk that the depreciation of your currency vis-a-vis the dollar might pass through into your domestic inflation and into your domestic inflation expectations. That is precisely the kind of environment, or the balance sheet effects, the fact that the rapid depreciation could create problems in your corporate sector or in your banking sector. In response to that, then the IPF says, okay, there is room, there is a rationale for coming in, trying to moderate the appreciation of the dollar vis-a-vis your own currency. Now, if that remains still a fundamental change, it's just delaying the speed at which this is going to happen, but delaying the speed at which it happens can already be helpful. And I think that's sort of what we've been seeing from a number of economies. A number of countries have been moving in that direction. So when I look back at what we had in 2022, the configuration of shocks, the policies that were implemented by advanced economies, and how a number of emerging market economies responded, I would tend to say that many of these responses can be understood within the IPF. Now, the IPF for specific countries may come up with slightly different prescriptions, etc. But I think broadly, I think this is a good example of how this integrated framework can be much more useful in thinking about the combination of policies than just saying, okay, we're just going to respond with monetary policy per se, the interest rate rule that we would have with the Taylor rule, and we won't do anything else. So in a sense, the richness here was very helpful, and we've seen a number of responses that varies across countries, reflecting some of their initial conditions and the nature of the shocks that they faced and the nature of the frictions that they were exposed to.
Okay, thank you. Now let me ask Claudio if you can probably elaborate one point that you want to highlight as a lesson from last year's experience for EMEs.
Well, thank you, Ilhyock. Let me just go back to a very simple point. I think that, and this came out very clearly in what I think Pierre-Olivier has just said. I think that there is always a risk of trying to be too ambitious. As Pierre-Olivier said, shocks are very difficult to measure, the sources of the shocks, let alone in real time, but even exposed. We've had huge debates for many, many years about, for example, what has caused inflation and so on there. I think that quite apart from, you can identify shocks if you have a very precise model. But what happens here is that people have very different models about how the economy works. And in that context, it's an impossible task. It's conceptually impossible to identify shocks. So that takes me back to what I said earlier. I think the underlying philosophy, I think that should inspire or should guide a macro-financial stability framework is that of prudence, is that of safety buffers, understanding that good conditions tend to generate over time the seeds of their own reversal, effectively. So these cyclical movements of the economy. And that means that when things are good, you have to make sure that you build sufficient defenses. And going back to the specific question that you mentioned earlier, what is that we learned from this experience? More generally, what policymakers, I think, learned from this experience is that the constraints that we thought, or many thought had disappeared, in terms of inflation would not come back, you could actually push on the accelerator without creating tensions. Those constraints actually did come back. And this puts a premium again on prudence, on building buffers, on making sure that your fiscal policy is not out of line, that you have sufficient debt capacity in the economy, making sure that you have sufficient room for maneuver in monetary policy, making sure that you have sufficient buffers in the financial system. And to me, ultimately, that is what macro-financial stability frameworks are about. It's more like a philosophical approach to how you you design your policy than a very detailed prescription about optimization. It is not about optimization. It is about robust policies with sufficient safety margins in the economy, and the need to build up those safety margins when things are good, because things will not be good forever. So let me stop there.
You, Claudio.
Let me follow up on that. Actually,
yeah.
I think we'll be becoming integrated with the next room, but I'll keep it very brief. So just picking up what Pierre-Olivier said about last few years, I think we saw many countries, not just emerging markets, but also advanced economies, use a lot of macroprudential tools, especially on housing, to deal with the rise in house prices over the last few years. So that's well and good, but elaborating on what Claudio said, I think we should take a step back and ask whether the macroprudential policy itself is actually suited for stabilization or for resilience building. Because if you're using it for stabilization in the short term, you have to adjust the tools often and you rely on it to transmit rather quickly. But as the previous panel acknowledged, macroprudential tools often have come with long implementation lags, and transmission lags can also be quite long. So I think it's quite ambitious for you to be using macroprudential tools to steer the cycle, as opposed to more like a longer term resilience building. And I think the choice of instruments can help here. For example, if you compare loan to value instruments versus debt to income or debt service to income ratios, I think the latter has a more automatic stabilizing property than LTVs. When you think of when the housing is on an upswing, right? The price of the house goes up, LTV does not constrain how much you borrow relative to your income. So borrower resilience is not cushioned, lender resilience is not cushioned because the loss absorbing capacity is not being built up. But debt to income is actually conditional on income, and income tends to be less cyclical than property prices. So when the price of houses goes up, income is the same, so it binds more. So that's like an automatic stabilizer, just like you have in fiscal policy. That might be some way to get around that. But so just a caution note on I think macroprudential, how ambitious it could be in terms of the cyclical stabilization.
Thank you. Just very brief. One lesson we got from the last couple years. First one is, of course, the policy should be still consistent. Consistent meaning that consistent with the mandate. In terms of the monetary policy, then we take any policy to maintain the stability of the price. So that's why BI take several times to raise the rate. And then that's the first. The second thing should be innovative. Innovative meaning is not only with one single instrument, but also should be taken with other, consider the other one. And also related for the macroprudential policy. We know that we also implement the LTV, but the thing is that in Indonesia, the asset price is not really a concern for us. The concern is how we are trying to innovate to accelerate the recovery. So in this issue, BI just released a new policy in terms of macroprudential policy, when there is incentive for the bank who can lend to the priority sectors and therefore the inclusive and green. And then the third lesson is about the synergy. It's about collaborative with other institutions, because all the shock coming from outside, from the global shock supply, and then the other one from the financial market should be addressed in collaborative way. I'll stop there. Thank you.
All right, I guess we can probably start getting some questions from the floor. Actually, Firman just answered something about the question actually that came up from the virtual participant. So what was innovative this time? So thank you. So let me open the floor. If any questions from the floor to the panelists, please raise your hand. Oh, yes, I have one question over here. Yes.
Thank you. I'm Erwin from Development Bank Indonesia. So many shocks that we've been thinking about so far, right? And it's so difficult to manage those kind of shocks being a small open economy, right? So Firman, for example, Firman mentioned earlier that having those kind of problems in the shallow market and so on and so forth. So things getting worse and worse, right? But we haven't been talking about the source of shocks, right? So for example, no, today is, for example, where a lot of things happening in the US, and it will affect the exchange rates, and then we'll go through all those emerging economies and create problems and response. But I'm just wondering how the fund see these problems in terms of source of shocks, right? So we've been talking about how to manage the shocks, as an emerging economies. But how about the source of shock itself? Because we've been living in these international monetary systems where the currencies of particular countries become the global currencies. Right? So whatever happening in this particular country will affect everyone in the world. So I'm just wondering how the fund sees this kind of things, and how do you really talk to the US, for example, because it creates problems for all those countries, or whatever. I just wanted a view on that from Pierre, if you don't mind. Thank you.
So I think it's a question for you, Pierre-Olivier, but I guess if other panelists have anything to add, I guess that will be after Pierre-Olivier replies.
Yes, so this is obviously there's a body of empirical work that documents the fact that policy, especially in the core economy, because of the importance of the US dollar for currency invoicing, for financial transactions, in central bank reserves, etc., plays a disproportionate role. So you're right to point out that it also has an impact whenever a decision is taken at the center. It has implications. This is obviously something that, I spent part of my career as an academic before I joined the fund looking at pretty closely. So I'm very sympathetic to this notion. And obviously the fund is, as a multilateral institution, we're also concerned about spillovers, and we also spend a lot of time trying to think about the extent to which decisions that may be taken in one part of the world have positive or potentially negative spillovers elsewhere. In terms of the way this is approached, I think there is a lot of exchange that is going on at the level of central banks already. And there is a lot of attention that is paid by, for instance, the Federal Reserve to what might be the implications of its policies on the rest of the world. So I think these are not decisions that are taken in isolation, in a sense. But one has to keep in mind that the mandate of national central banks is to deliver price and financial stability for the area that they oversee, and therefore there is only so much that can be done in that direction. So I think part of the dialogue, part of the conversation that is going on, part of the awareness of some of the spillovers and potentially the spillbacks, because at the end of the day, if the rest of the world is not doing well, then the US is not doing well either. That's something that is increasingly part of the conversation, as it should be. So I think on that point we're having these conversations. Yes.
Thank you. Any other panelists wants to add? Okay, if not, then okay, one more question. Maybe that's going to be the last one. Yes, please. But it should be very short question, please. Yes.
Hello. In your opinion, how does affect the money market that can be problems or the challenges of ensuring the success of the operationalization of frameworks for integrated policy in each country, and how could COVID-19 affect the money market in the global? Thank you.
Just to confirm, the question was more on the money market?
Yeah.
Driven potential stress in the global financial system.
Yes.
Yes, I guess there's a very specific question, money market issue. I think it's probably related to the March 2020 episode. I think that's likely, but if any panelist wants to say anything about it, I guess, yeah. The question is, in the integrated policy framework context, we haven't said much about money market being some sort of either source or amplifier in global financial conditions and some specific market segments. So I think the question is, where does it fit? Okay, well, it's a very, I would say, very specific question. So if any of you have any views about the role of the money market in the context of IPF. integrated policy framework or MFSF. Any panelists
I mean,
can share? Yes, Piti, maybe you can go
No,
first.
I mean,
Yes.
if I understand the question correctly, the role of money markets in the integrated policy framework, I mean, at least the way I interpret your question, the money market is the key building block of a transmission of monetary policy as well as exchange rate policy to the broader market. So I think if I understand your question correctly, it is crucial to have the money market functioning well and orderly. But it's not so much we have a policy tool in particular to steer money markets apart from our policy rate, but just make sure that we have the ecosystem and the players and the infrastructure is very sound and solid. I think.
Yes, I guess just to add, when I mentioned the 4 objectives and 10 tools, actually 10 tools include both FX liquidity provision and domestic liquidity provision, which is basically about money market. So indeed, yeah, we do see time to time the money market issue, which is not necessarily bond market, very different characteristics. But central banks have tools, and quite often emerging market central banks have actually intervened in those markets as necessary. All right, I guess it was a long session, and let me just wrap up. So I'd like to thank all the panelists for excellent remarks and insights. So I think it's probably time for photo taking. So thank you.